The easiest, but also the only way to make money in trading is knowing where the price will go next. But in order to know where the next move is, you need to know the next draw on liquidity. The key difference between an unprofitable trader and a profitable trader is that the unprofitable trader tries to predict the next 3 steps of the market, while the experienced trader only wants to know the very next move of the market. Everything that happens after that is none of his business. So in this video, I'm going to simplify the concepts that I use to know where the next draw on liquidity is going to be. Now, before we're going to get into the actual price action, you have to understand a very fundamental concept. Now, liquidity is just fuel. You don't have to look too much into it if you're having swing highs and swing lows. You don't have to see it as market participants or anything like that. Now, yes, there is stop losses below trendline liquidity and all sorts of other liquidity or imbalances, but as a general rule of thumb, just mark it out like this. If you want the price to go higher, it needs to take out liquidity of the opposite direction, which in that case, it's going lower first, and then from here on, it can go higher. Now, sometimes it will also take out liquidity another time, and then from here on, it will actually show the move that it has attended for the day. So your job as a trader is basically knowing where the next draw on liquidity is. Now, a lot of different traders are trying to predict 2 or 3 different moves ahead. They're thinking that, okay, we're going to go in here, then we'll trade higher, take out liquidity another time, and then we'll go for that high. But what you should do as a trader is really just, what is the next move? So if you're in this point in time, you only want to know, okay, we're going for this low in here, and that's it. Now, this is going to be the entire entry model that we'll be using in this video. Quickly, I'm going to mention it out for you. If you're having some kind of price movement and you're just trading high, right? Then you want to take out liquidity, and from here on, you have already created the opposite direction of liquidity. What have you created while going lower? It's going to be FVGs. I'm going to mark it out for you. Now, this essentially is going to your EM. If you are not familiar with that, I've made an entire masterclass explaining all of this. Your previous day high is going to be right in here. Your relative equal highs are going to be those. Your FVG is of course that one. And your premium to discount is if you're going to mark out the high of the entire move and also the low. Then 50% of that is going to be what? The equilibrium. And this is essentially all that you really need. Now, this is just a textbook example, and it's just simplified in a basic line. Now I'll show you what that actually looks like in the real price action. Okay, so here we are at the price action. Now, as always, guys, I want you to keep it simple. Don't overcomplicate it. We're currently on a daily time frame, and if you have watched my entire masterclass, then you should already be familiar with the terms that I'm going to show you here. Now, what can we spot in here? This is essentially just a lot of liquidity that is sitting onto the time frame, right? There is a lot of different stop losses above these highs. So that also means that the market is going to target this entire area, because a lot of retail traders just believe that we have basically traded into it, we got rejected. We traded close to it, another time we got rejected. So they believe that we're going to trade close onto it another time, and from here on, we'll go for previous lows. Now, it is quite logical to think that, because yes, we're just trading lower and lower, we might as well just do that another time. The problem is just that the market has purposely built up a lot of liquidity in here so that the retail trader is just going to get stopped out. So from here, what else can we spot? It is very nearby. I want you to focus on just this little bit of price action alone. So what else is there? And I want you to really just focus on this entire price action for now, right? We have marked out the relative equal highs. Everything below here doesn't matter. What can you spot? We have taken out liquidity. Now, this may or may not be pretty obvious to you, but it actually holds weight. Every single candlestick tells a story. And this is not just liquidity taken and now we're just trading onto the upside. You actually have to understand why we have done that, and this is essentially our confirmation. If you are going to pay attention to all of these wicks, what are they telling you? We have taken out liquidity and shot immediately onto the upside. Traded into this FVG, we're not able to stay there, trade lower one more time. Now, by this point in time, this should already be your confirmation. Okay, from here, I am already ready to basically long. Because in that point in time, we also did not fulfill the equilibrium, right? So we already know that we have taken out liquidity. So essentially our fuel, as previously mentioned, to now go onto the upside. But we also need our EM, which is standing for established movement. Do we have that? Yes, we do. Why is that established movement? Because we had 2 candles. From this candle on, it was already confirmed. And if you're also going to combine that with liquidity, you have relative equal highs. Now this could be a trade on its own, but we're going to slowly go to the present time and analyze that further. From here on, the established movement was already confirmed and we're going to trade higher, which has happened. This entire candle is trading lower because we had this FEG in here. And this is also our confirmation that now we will trade higher. I've told you previously, in order for the price to move higher, we need to take out liquidity and then we can trade onto the original direction. A lot of people would see that this has not happened. We have not taken out liquidity. Now, it's right in front of your eyes. We have taken out liquidity one time, and this is going to be the second time. And if you don't believe me, then we're going to drop down onto the 4-hour time frame and see if that has actually happened. Now, you have a swing low in here. That's the first thing. But that is not just any swing low. It was failing to actually close above the previous candle high, right? So if you're just going to look at this entire price action from this point in time, right? Just ignore everything that has happened before. This candle is the all-time high in that sense. And this candle was not able to break through of that. We have traded lower, and to some of you guys, this will be a market structure shift, right? We have all seen it from ICT and these SMC guys who are not profitable to begin with, that they're just going to trade onto the downside. But how do we know if we're actually going to stay there? That is why it's so important that we have done our analysis beforehand on a daily time frame, because now we know that this was all just a fake move, and this is the real move which we're actually going to trade towards. Now, these are going to be additional relative equal highs, but to be more specific, this is going to be your internal relative equal high. Why? Because those are going to be your external relative equal highs just mentioned onto the daily time frame. So that is telling us that we not only have the higher time frame bias, but we also have the lower time frame bias to actually trade onto the upside. So if we're going to drop down onto the 1-hour time frame and we want to go to 0 AM UTC standard time. Now, depending on if the liquidity has been taken out or not, we are going to take a trade depending on the price action, right? So we've skipped the entire day and we have actually traded higher, but you can see that the previous day high has not been taken out. And if you have seen the model that I've just shown you, basically entry model, then what is that? You have the relative equal highs, you have the internal relative equal highs. Yes, they have already been taken out, but there was still liquidity to trade higher into. And you essentially have the entire thing that I've just told you about the entire model. If we're going to drop down onto the 1-hour time frame, so we are at 0 AM UTC standard time. Why is that? Because the next candle is going to be 0 AM. And from here, we want to simply take a trade onto the upside. Now, this is going to be the previous day high. And we could potentially base our trade off that previous day high. I mean, out of experience, I already know that your take profit can be 10 pips. Your stop loss is going to aim for close to 50 pips. Now, I'll also show you an example where it's more obvious and where you can put your stop loss. Usually, you would like to see onto the time frame some kind of low that we have traded into. So now this is going to become a protective swing low, because a low that falls back into an FEG is just protected by the market. That has happened in here. The problem with that is just that if we're going to base it off from here, that's not too close to 50 pips. So if it's not close to 50 pips, we're also not going to take it in that sense. And if there is no logical level, then you just want to stay to the hard rule of putting it to 50 pips. From here, we want to risk 3%. It's very important because the win rate of my strategy is so high that you're not going to lose 3 times in a row. I've made an entire video explaining a negative versus reward. If you want to watch that, it's explained multiple different times in my channel. Now from here, if FX Replay would be a professional platform, we would be taking a trade, but it's not doing that, so I have to refresh the site. Now quickly guys, over the years, I've most likely tried every single journal that is out there, but none of them has actually come close to what TradeLens is going to give you. TradeLens has an integrated AI assistant, which is going to help you further analyze and understand your trading behavior. I'm using it myself, and if you want a 10% discount on every single purchase, the link to that is in the description down below. So from here, we want to always risk 3% on every single trade. The reason for that is because my win rate is just extremely high. You're not going to lose like 3 times in a row, so it's also very platform friendly. It has a 95% win rate in case you're wondering. So this was an easy take profit hit. Now granted, our stop loss is wide, so obviously we are shooting for a higher win rate. But that's the purpose of it, because we're going to stick to it and be way less attached of the outcome, because we know we're most likely going to win that day. So I am going to go up onto the daily time frame, remove a couple of things, And we're just basically going to repeat the process. You don't have to mark out every single day the chart new, right? If you already have the external relative highs, the liquidity taken, and other things, then you don't need to basically do it every single time. We're going to skip this entire candle as this has already printed. Now, in this strategy, it's more important knowing when not to trade compared to knowing when to trade. Losing with a negative risk reward is admittedly quite significant. If you're going to lose with a negative risk reward, it's going to set you back a couple of losses. This is what you sign up to when having this high of a win rate. So this one is actually a very good case study on where not to trade. Do you see this entire candle? Now this currently is on the daily time frame. And I want to ask you as the viewer a very simple question. Or any time that you are looking at the time frame and you want to take a trade that day, I want you to ask yourself that question. Are we going for the previous day high or for the previous day low? Since this is just simply a doji candle, right? We're neither taking out the high or the lows of this entire price action simply because we're just hovering around. And we have ended up right in the middle where the candle has opened. We don't really know if we're going to go for the high or for the low. Simple as that. So these days should just completely be ignored and avoided. You can't tell for the high or for the low. Now, given the framework, right? This is why context matters. We're probably going to go for the upside, not for the downside. We have already taken out liquidity and have more liquidity higher. But is this a day that I would like to participate in? No. Especially when you're managing large funds, this is just simply not worth it. So we're going to skip the entire day and let's see what happens. This is already a way different story and something that we would love to trade. Why is that? Because now we have our entire established movement onto the upside. This was the previous established movement candle because we have traded higher, created liquidity, and yada yada yada. Now in this one, we are not sure. However, the next candle, so currently, we're having our established movement. It has broken through the previous candle, which was indecisive, and that is essentially going to be our confirmation. From here, we want to ask ourselves the question one more time. Are we going for the previous day high or are we going for the previous day low? Once again, if the answer is I don't know, then you don't want to trade that day. Now, and the answer couldn't be more simple and probably you have already figured it out. We're going for the upside, not for the downside because we have already movement higher. So I'm going to remove the previous day low and we'll drop down onto the 4-hour time frame. Now, can we spot more reasons on why we should actually continue higher? In every single trade scenario, there will always be reasons why you should also not take a trade. Anybody who tells you that look out for 10 different confirmations before you're entering a trade, that is not a bad advice. The problem is just that you also have to look out for the opposite direction. Now, if you're going to look closely, what are those? These are relative equal lows. What happens to relative equal lows? They like to be traded back into, mitigated, and then from there on you can go higher or lower. Now in this case, it's going to be higher. The problem is just that we are entering at the 0 AM candle, and for us to basically trade onto the upside, we would have to endure, quite a bit of drawdown. Now, granted, we are having a wide of a stop loss, so this is quite fine for us. So now we're on the 1 hour and we always want to start at the 0 AM candle. Now, we have reasons to go lower, which are going to be the relative equal lows. So this is a major reason why the trade could not work out. I've told you previously, you need to look out for things that are speaking against the trade, not just for confirmation. I am going to mark out the original trade idea, and from here on we're just going to break down the entire trade. On the 1 hour time frame, we know that we are going higher, right? This essentially is a massive uptrend on the 1 hour. On a daily time frame, this is not a massive uptrend, but this is definitely already established movement. If we're going to go into the weekly time frame, it's going to be even more obvious that we're just simply trading into this liquidity, which is the FEG and also the relative equal highs. Now on the 1 hour time frame, we still have the relative equal lows. So to a lot of people, this would be a very big problem. Are we trading lower than higher, or are we just trading higher, or are we just going to go even way lower? No, not really. Now pay attention. If we have this candle low, which basically initiated the reason why we broke this entire high, this is why we're going to take this low and we're going to put it right in this high, because in that point of time, it was the highest point compared to this low. We have not traded into an equilibrium, so we have to readjust our entire Fibonacci to the highest price possible. In that case, have we fallen back into an equilibrium? No, we didn't. Remember guys, we always like to trade back into an equilibrium and then higher. And this might be very confusing to you, right? Because you have named 10 different reasons why to take a trade and 10 different reasons not to. This is why I want you to take a closer look onto the daily time frame once again. Yes, we do have relative equal lows, we do have the premium to discount, But in order for you to keep it as simple as possible, just look at the higher time frame. Simple as that. The higher time frame is going to tell you the major story, while the lower time frame is rather just going to be for entry refinements, your stop loss, and take profit. The higher time frame should be the entire trade idea in that sense. Everything around that is just going to be refinements and other nuances. So even in that case, even if you have reasons to go lower, this is all just on the 1 hour time frame. What matters more is what we have on the daily time frame. And from here on, we want to always risk 3%. As previously mentioned, this is going to ensure that we're just going to make a lot of money out of it, even when trading a negative risk reward. Now from here, we are just going to let the trade play out and see what's going to happen. Now this is another take profit hit, and essentially it is just very easy to break it down for you. Now as a simple conclusion, we had the previous day high aligning well with our bias, right? We had reasons also why the trade is not going to work out, but higher time frame is just telling a way different story that we need to trade on to the upside. Now, and you could basically just repeat this for every single following day until the move is exhausted. Now remember, the longer a trend goes, the more likely it becomes that it's just going to reverse on you. In that case, you could basically just long this up until these relative equal highs. From there, you would need some kind of other framework, some kind of other idea. Maybe it's going to be established movement onto the downside, upside. You'll basically have to regroup the entire trade idea. But once you have found basically that gold mine of just longing, it's going to be a very easy story for you to make a lot of money out of it. So this is basically it, guys. I am always trying to keep it as simple as possible, and you should do the same in your trading. Now, if you still have a couple of questions and you're not familiar enough with my way of trading, then click on this video, because this is the full masterclass. It will explain to you everything from A to Z on how to become profitable and how I'm doing this on a day-to-day basis. Now, if you have still not clicked on the video, then like the video, subscribe to the channel, and comment down below what helped you the most out of this video. See you guys next one.